Investment Officer of CastleArk Management. And Jerry, you've been looking at ways investors can protect their portfolio from inflation. Top pick is energy. Tell us why.
Well, I mean, the Fed has the same problem you and I do, and basically the economies in the world. We just can't predict today how long it will take high rates to slow inflation. We can't predict how long the Chinese economy will stay under lockdown, and we can't predict how long the war will last in Russia. All we can do as investors is try to assign enough high probability outcomes to the different investments we have. And the one way we feel is really obvious is to just have a nice set aside for inflation sensitive stocks, and specifically energy stocks, the names that will have the greatest upside in the event of some continuation of inflation, but also give you some downside protection in the event that there's a market that really craves yield and Warren Buffett buying stock. So it's this nice in between that you don't have to have this debate. You can own a part of the market that kind of buttresses one side of your portfolio and gives you upside on the other.
Is there an argument, Jerry, to take out the specific security risk of owning a single security or a couple of securities, whether it's Exxon or EQT or Devon or whomever, whichever I should say, and buying instead an ETF, or a fund that is an energy fund, and just buy a basket of the stocks?
I wouldn't argue with that for a second. I mean, in the big XLE, for example, it's dominated by Exxon and Chevron. Those are two great names. If you want to get a little more growth, but a little more risk, the XOP offers that to you. So you've made a great point. And the important thing is you need to have a collection of names or at least some bulk word in the portfolio that has these unique characteristics.
Playing the consumer has become increasingly difficult, Jerry, to say the least, as we hear from Walmart, Macy's, other consumer-facing names. But you still have some picks, Ulta and Nike. Why do you think these two names are ways investors should protect their portfolio from rising prices?
Yeah, well, in both cases, one is a retailer and the other is a manufacturer. Both of them have something very, very powerful. Ulta is by far the one-stop shop. And no one's challenged that, and its sales have continued to thrive here, and we think this is going to continue. And Nike's this global brand. I mean, we're sitting on top of probably their greatest brand recognition in the history of the company right now, and we think that just squashes the poor competitors in both cases, and that gives you what you've seen out of these companies, which is the strength of their underlying franchise.
And kids, two observations there. One, with respect to Nike, if you're a Nike kid and you've grown up with Nike, you stick with Nike, and you don't want, that's called good drip. You do not want the competitor. You're about the fourth person this week who's mentioned Ulta. Maybe I need to go in one of these stores.
And reporting earnings tonight.
I'll go with you.
Yeah, because everybody talks about them as being one of the great plays right now, as you do. What makes them different and better?
It's just the branding and the product offerings they have. None of these types of businesses are dominant forever. But if you go through the history of the Dick's Sporting Goods, the Ultas, the companies that nail it in terms of the current brand interest, they're in that spot right now, and it could be 5 years before they give that back.